Yeah. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through, thinking about all the shit that I've been through. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through, thinking about all the shit that I've been through. Now I'm sipping on this whiskey. Got one chance and it's risky, so you can't play around. And I got my team behind me like a background. I don't never back down, picking up the slack now. Now I'm focused, keep on grinding for my stacks now. I'm feeling lost in this ocean, where's a lighthouse? I keep on swinging for the fence and I ain't strike out. And yeah, that's how I'm feeling, yeah, that's how I'm feeling now. We're not here for a long time, yeah. It's 9 to 5, it's a long grind, yeah. A lot of to success, it's a long climb, yeah. Now I'm sitting here making up for time, yeah. Man, I took so many losses that I lost count. I didn't know what I was made of, but I found out. And this life will blindside, you better look out. These haters wanna see you fall and get you took out, yeah. Cause I fell on my face, and this life is a race. I keep on checking my place. Now I'm riding for my team, you can tell by my plates. And this life just threw a hook, it caught me right in the face. But I'm getting back up, I'll do whatever it takes. I'll climb a couple of mountains, I'll swim a couple of lakes. Don't got time for that bitching, don't got time for complaints. Now you going through some shit, now tell me how does it taste? You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through, thinking about all the shit that I've been through. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through.
Cheers, motherfuckers.
All the shit that I've been through. Now I'm living with my choices, I just own my mistakes. Cause I'm screaming fucking hand down, I ain't searching for breaks. But I'm barely treading water and this life is the lake. Now the pressure keeps on building as I'm raising the stakes. I ain't looking for advice, now I'm looking for space. Now I'm dealing with these losses, but I know I hate the taste. Now I'm sitting
Cheers,
back
brother.
and thinking as I smoke it to the face. Now it's time for these apologies, the time is too late. So bygones be bygones, I'm on business with a tie on. So fuck a shoulder to cry on, I'ma get a hopper like Zion. Let's raise a glass, I'll toast that. Reminisce, we roast that. How I wrote them and ain't wrote back. I'm never flimsy, the goat's back. So I don't feel bad, no not at all. With a lot of years, write a lot of calls, a lot of birthdays without a call. Ain't got time for that, so fuck a fraud. You ain't there for me, I ain't there for you. You won't bleed for me, I won't bleed for you. All the hard times I lived through, keep moving, gotta get through. I got goals and cash, I gotta get to. All these memories that I flipped through. If you can't relate, then don't judge. I'll stand my ground, I won't budge. I'm sitting back cause I burn buds. I swear to God, this life's good. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through, thinking about all the shit that I've been through. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through, thinking about all the shit that I've been through.
What's going on, fellow retail investors? Butcher Wall Street here. Got a little poll in the chat, and it says, did you take Viagra, or is that AMC's cost to borrow in your pocket? Because the average is now 870%. Can't really see it on this side. Beneath the chat, it looks like. But it sure is. The average cost to borrow on AMC is 870%. The maximum's at 1,050%, and the minimum is at 368%. Looking at a borrowed change of 329,000 shares, more shares borrowed than returned today. 25.14% live short interest percentage from Ortex. And then, of course, we all know that's self-reported data, right? All this short interest is self-reported by the prime brokers, hedge funds, and banks. And that really leaves a lot of room for manipulation, such as the manipulation that occurred between market makers, prime brokers, and broker-dealers with January 28th, 2021, and the removal of the buy button on a variety of stocks like AMC, GameStop, COS. You're going to see that now. There is a new lawsuit that has just come up against Robinhood. Robinhood makes the majority of their money from payment for order flow, and they have been very active and loud in speaking against some of the regulations that the SEC has just implemented. You guys are going to get a kick out of this. But they're over here tweeting about the SEC proposed rules that would turn back the clock, fundamentally and negatively changing the way retail investor stock trades are executed. And they say this because their main source of income, payment for order flow, is going to be negatively affected. Regardless, it's got 125,000 views and only 141 likes and 78 retweets, which is pretty pathetic for a broker-dealer. Let's take a look at the comments and see what people are thinking. Well, you already saw my comment. So you don't deserve the name Robinhood. You literally turned off the buy button. I'm digging the we care cosplay. You should turn off the comments button like you did the buy button. You're a bunch of crooks. Take away the buy button when trades don't go your way. Sound familiar? Retail wants a fair market. You crooks, including Citadel, making sure retail can't win. Hope you all go to jail for your crimes. Let people trade, said Robinhood in 2016. Just a few years before they took away the buy button on AMC and GameStop, and so on. Other people saying, you got the worst fill forever for spreads, especially when the customer is winning, not even below bid. You're thieves. Get jigs up, guys. Time to fold, and nobody's falling for the Ponzi scheme. Coming from Robinhood, that's rich. You want to keep things the way they are and love that younger, inexperienced traders use your platform because it allows you to rob them on an unprecedented level. And he's talking about payment for order flow. All of these people are, because they're aware that payment for order flow does not help the retail investors. It routes your orders through not dark pools, but through the over-the-counter OTC market. That means trades go from point A to point B without ever getting to their destination. They never hit the ticker tape. They never hit the NYSE. They get traded on the OTC. And that is the main problem here. That's why so many people are telling Robinhood to basically shut the fuck up. There's been a class action lawsuit that we just found out about today because it was filed today. And this lawsuit, to get more in depth, I've already got it open, states as follows that a highly experienced class action law firm announces that it's filed a class action lawsuit in the United States District Court of California to represent investors who held call options on the Robinhood trading platform as of the close on January 27th, 2021, through and including February 19th of 2021, to purchase any of the following stocks: American Airlines Group, AMC Entertainment Holdings, BlackBerry, Bed Bath & Beyond, GameStop, or Nokia Corporation. The affected options: sold such options or such options expired during the period of January 28th through February 19th of 2021 and thereby suffered a loss. The lawsuit alleges that on January 28th, 2021, Robinhood and two of its wholly owned subsidiaries prohibited the purchase of stocks underlying the affected options on its platform and also prohibited purchases or the exercise of the affected options, and thereby only allowed the closing of such positions. The lawsuit further alleges that during the period of January 29th through February 4th, Robinhood imposed significant limits on any such purchases and continued to prevent the exercise of affected options on its trading platform. Consequently, the value of the affected options dropped dramatically and remained depressed through at least February 19th of 2021, and individual retail investors holding affected options suffered significant losses. It is alleged that by virtue of these purchase and exercise prohibitions and limitations, Robinhood engaged in market manipulation in violation of Sections 9A and 10B of the SEC Act of 1934 and several others. By this lawsuit, plaintiffs seek to recover damages for those holders of the affected options who suffered losses resulting from this alleged market manipulation. So the lead plaintiff process permits any investor who held these affected options on the Robinhood trading platform as of January 27th, who sold such options or such options expired during the class period, to seek appointment as lead plaintiff in this class action lawsuit. Okay, this generally is the movement with the greatest financials interest in the relief sought by the putative class, who's also typically an adequate of the putative class. Okay. Basically, no class has yet been certified in the above action. Until a class is certified, you are not represented by counsel until you retain one, but you are not required to retain counsel. You may remain an absent class member and do nothing at this point, and investors' ability to share in any potential future recovery is not dependent upon serving as lead plaintiff or retaining counsel at this time. So you can contact counsel of your choosing. You can contact an attorney for legal advice. I'm not an attorney whatsoever, and this is not legal advice. You can contact your attorney, or you can also contact the attorneys here at the Clafter Lesser LP law firm via email or phone. And they say they have extensive experience in prosecuting class actions, and who have extensive class action experience have recovered over $1 billion for the benefit of classes in numerous cases. Please visit our website for more information. All right. Disclaimer. Here's their contact information, phone number for Jeffrey Clafter. I bet they probably get a lot of emails. Here's the email addresses: info@pessahgroup.com or email Stuart, Stuart, at chelinlaw, CHELINLAW.com. So you can contact them for more information. Again, this is not legal advice, but it definitely appears to be the winding up of a class action lawsuit, and like law firms are currently petitioning to become the lead plaintiff in this process. They have until June 9th, 2023 to do so. So if you were affected by Robinhood or other broker-dealers, this is your opportunity. This is your opportunity to join a class action lawsuit or similar action lawsuit against the Robinhood, broker-dealers, and potentially market makers. So there's a link to it on my Twitter at BossBlunts1 if you need my handle. I just tweeted this earlier today. And you guys can check it out there. I'll drop it in the comments at the end of this video as well. Now, this is not something new to retail investors, new investors of AMC, GameStop, and other meme stocks. Goldman Sachs submitted an AWL, which is AWC, on the condition that, if accepted, FINRA would not bring further actions against Robinhood, against Goldman Sachs, and the alleging violations are based on the same factual findings described in this FAC. They said clearly that Goldman Sachs, from October 15th to April 2018, mismarked long positions, approximately 60 million short sale orders, totaling more than 14 billion shares. So they mismarked as long over 60 million orders that were sold short, which equates to over 14 billion shares of stock. This is nothing new for retail investors that have been doing homework in this space and due diligence, and a lot of investors of stocks like AMC, GameStop, etc., and the other meme stocks that have been mentioned, and even more that have not been mentioned. Due to the inaccurate long mark, 12,335 of the executed orders were executed at or below the national best bid, while a short sale circuit breaker was in effect. This means that while they were legally not able to short the stock, they still sent through over around 12,500 executed orders containing likely hundreds of thousands, probably millions and millions of shares, while circuit breakers were in effect, and that is direct market manipulation. These mismarked orders also caused the firm to submit inaccurate trade reports to FINRA and maintain inaccurate books. They were fined a measly $3 million for selling short but marking long 14 billion shares of stock. And it's not just limited to one ticker or two, but to most likely the most heavily shorted stocks on the stock market. Right now you can see that nothing really has changed for AMC except for the short interest goes up again, and the cost to borrow average is up higher. So now the short interest is higher than I've ever seen it, or at 25.14%, with an 870% average, 1,050% maximum and 368.29% minimum. Make sure you guys are checking out for your brokers. I don't have any answers, any legal answers. If you want legal answers, contact an attorney or one of the attorneys mentioned. I'm seeing some questions up there, guys, that I cannot give you the answers to. But make sure you check your broker and make sure, if you don't want them to lend your shares, that they're not doing so. Because somebody you've seen here on the channel before, my friend Woody Wooderson from Telegram, AMC for Everyone on Twitter, contacted Public and found out that Public does indeed lend your shares. They said, "Thank you for reaching out. I have added you to our opt-out list. Please allow 24 to 48 hours for your request to be fully processed by a clearing firm." They are basically 100% telling this guy that we have you automatically in our share lending program. That is public, that has been pushed by a lot of people out there, such as Matt Kors and other investors that claim to be pro-retail investors, but have no interest in looking out for them whatsoever. I recently left Interactive Brokers because their UK division and the American division recently came out with new disclaimers and user terms of services. And the UK division specifically stated that everybody would be automatically opted in to their share lending program and they would not have the opportunity to opt out. And the same goes for certain American users of Interactive Brokers, IBKR, with a certain dollar amount or a certain value of shares per my understanding. But do check your own user terms of service, as this is not legal or financial advice, and you have to do your own due diligence. Don't take my word for it. But yeah, contact Public if you have Public, and IBKR and all these other guys, Webull, you name it, Robinhood especially. These guys are going to do whatever they want with your shares, but you have to get it in writing that you are not in the share lending program and that your shares are not being lent. Even on Webull, the borrow fee for AMC remains at 995%. This is astronomically high. Astronomically high, you guys. Looks like yesterday you reported at 995, and then today as well, 995.27%. This is a major problem that we're seeing here. And a lot of the biggest problem with these heavily shorted stocks is that eventually, the problem for short hedge funds and prime brokers and broker dealers is that eventually, just like we saw in January of 2021 when they pulled the buy button, and June of 2021 when AMC sold more shares of stock, these stocks are most likely going to have a significant increase in their value. And usually that happens during economic turmoil, bank lending credit crunches, real estate market collapses, and stock market devaluations. So let's put it simply, what's a stock market devaluation period? A crash, if you will. The majority of crashes happen very slowly at first and then very, very quickly. Take a look what we've got here. These are container spot rates. This is from the Freightos Baltic Daily Index. The prices for a container to ship from China to the United States to the West Coast. The prices are dropping and they're at the lowest level that they've been in the history of the Freightos Baltic Index, which began in 2016. Earlier this month, they dropped below $1,000 to $990. They're now at $1,007, and rates are down 94% year over year. Some people in the industry might think that this is good, but in reality, this is just shows the weakness of the world's GDP and the world's economy. The fact that they're collapsing rates. As the owner of a logistics company, I can assure you that what we're seeing now in transport is similar to what we saw in 2008 and 2001, because trucking and transport are always one of the last to fail before a complete stock market and bond market crash. Taking a look at the global container freight rates, this is the cost of 40-foot containers. They're lower now than they were in February of 2020. Pre-COVID, they were $1,468. At the peak, September of 2021, they were at $11,109. And as of April 7th of this year, 2023, they're at $1,416. That's lower than it was pre-COVID, and that's lower than it was at their, much lower than it was at their peak, obviously. But it's not just ocean containers, freighters, rail yards, and ports that are having these problems. In 2019, there was an absolute bloodbath in the trucking market. My company is lucky to survive. We had to make some serious pivots and changes, but we survived. We've survived for over a decade now. But because conditions were so bad in 2019, trucking companies were collapsing and going bankrupt every single day. For carriers, motor carriers, trucking companies operating in the spot market, that means guys that don't have long-standing contracts, conditions are worse today than they were back in 2019. That means that we're going to see a huge collapse in trucking companies as well, because there are way too many drivers, way too many trucks on the road, and not enough freight. And during the great boom, the stimulus boom of 2021, when the federal government printed out shitloads of money and gave out lots of stimulus to businesses and people, and mainly large businesses and banks who received the vast majority of it, there was a massive over-leveraging of assets, such as trucks and trailers, tankers and warehouses. And a lot of that leads to the collapse in commercial real estate that we're currently seeing and the collapse in trucking that we're currently seeing. The current truckload spot rate, adjusted for inflation, is 18 cents per mile, worse today than it was during the bloodbath of 2019. It was at $1.47 back then, but accounting for the massive inflation we've seen over the last 3 to 4 years, the current truckload spot rate is still 18 cents worse than it was at that time. So the chart is only telling you half the story. Because even though it shows at $1.59, you got to adjust for inflation. That actually brings it much lower than the $1.47 back then. Lowest national average spot rate without fuel, this is not including fuel surcharge, in 2019 was $1.47 a mile. Now we're seeing higher operating costs for fleet vehicles, higher insurance, higher driver wages, higher maintenance costs, higher equipment costs, higher interest rates. Today, the national truckload spot rate is $1.59. Again, you got to adjust for inflation. That makes it 18 cents per mile lower than it was then. You guys are going to sadly see a lot of truck drivers, forklift drivers, office workers, personnel, shipping coordinators especially, etc. Not trying to choose them specifically, but all of these and then some that are related to transportation are going to be out of a job very soon, if they're not already. The earnings for trucking companies and brokerages and third-party logistics companies, distributors, warehouses is going to be an absolute bloodbath. Hey, everybody in the chat.
And one of say about the commodity and the economy. Well,
The economy is utterly fucked. This is what it means. For lack of other words. Check out downtown office vacancy rates. Downtown office vacancy rates, according to bar chart, 17.6%, significantly higher than even in the aftermath of the great financial crisis. Are you surprised? I'm not surprised. Take a look at all the empty warehouses, distribution centers, offices, stores that you see, restaurants. These problems are not just directly related to stocks, but they are indirectly related in one way or another through mortgage-backed securities, rehypothecation of assets and liabilities between banks, which are prime brokers, and broker-dealers for stocks, family offices and hedge funds, and even the clearinghouses, even the NSCC and the DTC. This is a major problem for all of them. Holger Scheipitz says, "Good morning from Germany, where construction investment is becoming a major growth risk for 2023. Construction price manufacturing index has plunged to 42.9%, which is a deeper contraction territory in March, reflecting accelerated decline in housing activity. Construction accounts for 12% of the entire German GDP." We're also looking at Germany. Good morning from Germany, where rate shock is hitting the housing market. The volume of new mortgages more than halved in February 2023. It's 54% decline, which is the worst on record. And total new mortgage businesses of $12 billion is the lowest it's been in 12 years. Not even accounting for inflation. So again, accounting for inflation, that business of 12 billion is even more insignificant than it would have been 4 years ago, 3 years ago. And taking a look at the gross domestic product and economy from the Bureau of Economic Analysis. This was just posted April 4th of this year. The real gross domestic product increased at an annual rate of 2.6% in the fourth quarter of 2022. With the third estimate, real GDP growth was revised down 0.1 percentage point from the second estimate issued in February. Why? Because the Bureau of Economic Analysis is always wrong. They're always trying to paint a rosy picture, and I've been saying the same thing since 2021 when we started this YouTube channel. And if you appreciate that and have learned something throughout this stream, feel free to subscribe if you'd like to learn more. Check out the real GDP percentage change from preceding quarter in 2020 during the COVID shutdown. As you can see, it collapsed. And of course, this giant stimulus, it jumped greater in the following quarter after that when the world was reopening. Now in 2022, we're seeing negative GDP in the first two quarters, and we're going to see that continue, in my opinion, in the following quarters of 2023. Look at the real GDP contributions. Consumer spending is up because inflation is up. Non-residential fixed investments, money markets, mutual funds, etc., bonds, and residential fixed investments are down massively because you're looking at people taking their money out of the housing market, out of apartment buildings, out of other residential condos and townhomes. Inventory investment is up massively because a lot of these retailers are getting stuck and these warehouses are getting stuck with their product, and it's taking them a lot longer to sell. That means more inventory on hand, which means more money lost. Inventory on hand for a period of time is a loss for retailers. Exports are also in the negative territory, while imports are increasing because this country doesn't make shit anymore. And federal government spending and state and local government spending are also massive contributors to the real GDP, the printing of money. Increases in structures and IP, mainly software, were partly offset by a decrease in equipment. Increase in federal government spending was led by non-defense spending. Increase in state and local government spending primarily reflected an increase in the compensation of state and local government employees. And within exports, a decrease in goods, led by non-durable goods, not including petroleum, was partly offset by an increase in services, led by travel as well as transport. Real gross domestic income, which is the sum of all incomes earned and costs incurred in the production of GDP, decreased 1.1% in the fourth quarter after increasing 2.8% in the third quarter. Taking a look at this, take a quick peek and see what's moving downwards. The largest decrease in change for gross domestic investment is residential real estate. that goes to show you that even here in the United States, companies and banks are investing less in residential real estate, apartment buildings, mortgage-backed securities, because they understand that they have to offload a lot of these toxic derivatives from their books. Decreases also followed in exports and goods, as you can see, which an increase in services, 0.72% increase in services, 0.76% increase in goods and imports, as stated. Now, really, what this means here, in my opinion, is when you look at the Bureau of Economic Analysis and the Fed's latest statements in their H.4.1, they're paying 4.9% interest rate on $3.4 trillion of bank reserves. They're paying 4.8% interest on $2.6 trillion in money market mutual funds that are parked overnight through the reverse repurchase program. So the Fed is basically shelling out about $300 billion on $6 trillion in cash. So on this $2.24 trillion daily in the RRP borrowing, they're coming out with around $300 billion in annualized spending, and that's more than the Fed earns on their portfolio. So the Treasury, the United States Treasury, is advancing funds to them. They're literally running and operating at a loss. Meanwhile, the banks are getting more and more money printed out of thin air. This is backstopped by the United States Treasury, which means it comes from the American people. This right here is a slow-moving train crash. All right, we're seeing oil absolutely becoming, oil prices, just getting higher and higher as the actual number of barrels of oil being produced by OPEC is greatly decreasing. Following the oil crisis of the 70s that we had, we saw supplies that were squeezed, much like they're being squeezed right now, and prices skyrocketing. And there was things implemented then to help the industrialized countries in combating the crisis. Right now, what is the government going to do? Are they going to print more money? That's just going to increase inflation. That's why we're looking at possible higher CPI this month. And the Fed is going to keep cutting, and they're going to cut for longer. You are not going to see an increase in inflation this next CPI reading, in my opinion. And the Fed will continue to raise rates this time and at the next FOMC meeting, and probably the meeting after that as well. Currently, the United States Strategic Petroleum Reserve is at the lowest levels that we've seen since 1983. The United States Treasury Secretary, also Janet Yellen, my ex-girlfriend, which I broke up with because she's a fucking lying bitch, warned us last month that climate change could trigger asset value losses. And she's not talking about the weather. She's talking about the situations going on in big banks. And that could trigger huge asset value losses that would harm the United States economy. The irresponsible monetary policy set forth by the Federal Reserve and other central banks like the ECB, New Zealand, Canada, you name it, they've been pursuing since the last financial crisis a massive asset bubble that we're seeing now in everything. It is rapidly deflating, and it leaves them scrambling to blame everyone except themselves. This is the exact same thing that I was telling you guys was going to happen when I posted this on Reddit and Twitter and YouTube on August 11th of 2021. Dark pool use at the time by the top 4 banks increased 38% in the first quarter of 2021 alone. Credit default swaps increased 3,437%. The reason for that was to hedge against their mortgage-backed securities and their other over-leveraged positions. At the time that those... They had 168 trillion fucking dollars in unrealized losses in the derivatives market alone. that's notional, but regardless, it's all rehypothecated. And assets and liabilities are mismarked. Shorts are marked as long all the time. And assets are constantly being borrowed, such as Evergrande bonds and United States Treasury bonds, which have a potential to lose a lot of value extremely quickly. And a lot of those are rehypothecations of assets, which by big banks are currently using bilateral netting and the continuous net settlement system in order to make it seem as if it's a much lower amount by betting the two values against each other. So saying my $1 billion loss compared to your $1 billion loss, it just writes itself off. But in reality, that's not the way this works during a financial collapse. These top four banks alone have $168 trillion in unrealized losses in the derivatives market. And this was then. When you take into account all of them combined, well, you're looking at hundreds of trillions. 190 trillion in derivatives losses. There are over 1,000, I believe 1,100 banks that trade in the derivatives market. And the gold ones here, I mean, so the orange ones, whatever you want to call it, are the top four banks alone. The ones that you would call too big to fail.
I call it moral hazard.
Hell yeah. It's a massive moral hazard. But remember, this does not include additional unrealized losses like naked shorts, synthetic shares, failures to deliver, shorts marked as long, rehypothecations, married and divorced puts, tokenized securities, which are not backed by anything, such as those found at FTX and Bittrex. Which, for those of you unaware, Bittrex is closing their United States division. Yep, you heard me. Bittrex is closing their U.S. division. I'm not surprised. That might be why the cost to borrow on AMC continues to skyrocket. So really, I'd like to say happy Easter to everybody. I hope you had a great Easter weekend. I'd like to thank the Lord for providing us with another day on this wonderful earth to fight this battle. And secondly, I'd like to thank short hedge funds for giving us the opportunity to become filthy fucking rich. Because don't take my word for it. Do your own due diligence, of course. But if you've seen what happened with AMC and GameStop in January and June of 2021, well, you've seen that they're the most volatile stocks in the stock market. And that's the reason why Robinhood had to pull the buy button, is now getting sued in a potential class action as of April 10th, 2023. And there's a long way to go.
Hell yeah, we love it.
Heavily shorted meme stocks are a massive problem for short hedge funds, family offices, broker-dealers, prime brokers, and even the clearinghouses. Short hedge funds and family offices like Archegos took out bad bets on AMC and GameStop and collapsed. Their prime brokers, like Credit Suisse, were left with the legacy problems from these companies, family offices like Credit Suisse, like Archegos. And those legacy problems led them to collapse and get bought up by companies like UBS. Now, broker-dealers like Robinhood and Webull, Interactive Brokers, and a dozen others had to pull the buy button on these heavily shorted stocks like AMC and GameStop, etc., BlackBerry, BBY, MMAT, COS, and many others, because short hedge funds and family offices like Archegos were collapsing. That means that the price of the stocks were going through the roof, running up hundreds and thousands of percentage points, making a lot of retail investors filthy fucking rich.
Yeah. Where were the regulators? Nowhere.
Damn right. They were nowhere to be seen. They were just out there watching it happen. because the clearinghouses are also in danger. The broker-dealers were in danger because they lent shares out to companies like Archegos. And these short hedge funds and family offices lost a lot of money on their over-leveraged swaps, derivatives, contracts, futures, betting against these stocks and shorting them, naked shorting them, and creating synthetic shares in order to short them. Those broker-dealers were losing so much money and weren't able to find shares from the people to whom they lent them to, like Archegos, that they had to physically pull the buy button, because when retail investors were exercising their options and their call contracts, the broker-dealers had to go out and fetch them at whatever price, whether it was $1, $400, $1,000, $10,000 a share. Broker-dealers had to go out there and get them in order to deliver them to the retail investor, because the Archegos, the short, was unable to pick any up on the open market, because diamond-handed apes, retail investors, were holding onto the shares and not fucking selling. The clearinghouses did not say anything to retail directly, but obviously they must have said something, I allege, to Apex Clearing and to Citadel, the largest market makers and clearinghouses in existence. That's why they were also, and Virtue Financial. Don't let me leave out Virtue. All of these guys are at great risk of insolvency. And the fact of the matter is that retail holds the cards. Nothing has changed. I've only increased my position in AMC. And I currently don't have a position in GameStop, but I think it's time I take another one out. Nothing has changed in terms of have the shorts close their positions, because they obviously have not. If they had, well, AMC's cost to borrow wouldn't be at 870% on average, or 1,050% on the maximum. The short interest wouldn't be 25.14%. Same thing goes for GameStop. Their short interest, I think, is hovering around 23% right now. And this is all self-reported data. Just like Goldman Sachs self-reported themselves, marking 14 billion short shares sold short as long. We're seeing short interest being reported by prime brokers, short hedge funds, short family offices, and market makers in whatever way they want. They're reported to the exchanges, self-reported, and then the exchanges provide 85% of that data to Ortex. So I wonder what's in the other 15% of the data and all the additional data that trades on the OTC market that does not hit the ticker, that does not hit the NBBO, that goes from one desk to another in the ISDA, swaps, derivatives, contracts, futures, OTC markets. This is not financial advice, and I'm not a financial advisor. You should do your own due diligence. Don't take my word for anything. But I've done my due diligence, and nothing will convince me that we're not about to be filthy fucking rich. Oh man, this is so much fucking fun. I could do this all day. But honestly, who wants to watch a 24-hour long video? I've gone on for about 44 minutes now. And I can go on for 44 hours more. There's just so much due diligence to provide. But no one's got the mental capacity to retain that much information. So I wish you peace and wealth. I thank you for joining us. We've got 462 votes so far. Let's take a quick peek and see what are the results. Let me just mute the video real quick so we don't get a ton of feedback. Yeah, shut up, guy. All right, and see what the results are in the chat. Did you take Viagra, or is that AMC's cost to borrow in your pocket? Looks like 88% of people's got an AMC chub. You guys are fucking hilarious. I love it. I love it. Let's wrap this poll up. 88% of retail investors. Here you go, guys. I'll give you a link right now. Thanks, Hilsey. Give you a link to the article from the attorneys for the Robinhood lawsuit. Contact your attorneys or contact these people. I don't give a shit. I'm not an attorney, so don't look at me. Do whatever the hell you think is right. Get a second opinion. I look forward to the next one, my friends. Cash Money, get the fucking money printer out, bro. Teach Jerome Powell how to use it. Come on, old yeller. Oh, but before I go, don't forget, Thomas Peterfy, the chief executive officer of IBKR, said, quote, I quote, "So, if the longs had known that they had the right to ask for those shares, and they really wanted the short squeeze, that's what they would have done." End quote. And he's talking about retail investors with long call contracts exercising their shares of AMC and GameStop. That's what would have done. That's what would have caused the short squeeze. At that time, because there have been several, for which Robinhood is currently being sued for removing the buy button on AMC, GameStop, BBBY, BB, GME, AMC, AAL, and NOK. Amongst others. There were others that were also pulled, like KOSS, KOSS, and a few others. Thomas Peterfy, this is another article that I wrote last year on Reddit, said there was 50 million registered GameStop shares available. Leading up to January 28th of 2021, Melvin Capital directly shorted GameStop. They didn't use the OTC market, the ISDA contracts, the swaps, the futures, the married puts. They didn't use depository receipts. They didn't use divorce calls and puts, the married calls and puts. They didn't use tokenized securities. This caused 140% short interest to be visible to the human eye, just like we're looking now on the Ortex self-reported data for AMC. And there were 75 million shares sold short that needed to be purchased by broker-dealers and short hedge funds. There was an additional 150 million additional shares outstanding via call options, but only if retail had exercised some of those call contracts. Ladies and gentlemen, this is why I tell you that weekly options, in my opinion, weeklies are garbage. But long-dated, long-term call contracts are the short hedge funds, the prime brokers, the broker-dealers, the clearinghouses' worst enemy. This is their greatest fear, that retail wises up. That's why a campaign was launched in 2021 to tell retailers to stop buying options, to say that you're feeding the market makers tons of money. They make a small premium on those. That small premium on those call contracts when they sell them aren't worth shit if they're losing billions and billions of dollars once or twice a year to retail investors because they have to close their short positions and deliver those shares. If long calls had been exercised, shorts would have had to deliver 270 million shares alone on GameStop when only 50 million existed, and they were being diamond-handed by retail investors. The long broker-dealer would have had to buy those shares on the market at any price, pushing the price of GameStop and AMC higher and higher than ever before. Shorts wouldn't be able to afford to pay them, so the shorts would have defaulted on the broker-dealers that lent them the shares. The broker-dealers would default on the clearinghouses and the prime brokers. The prime brokers wouldn't be able to deliver those shares and pay the clearinghouses either, leading to an inevitable collapse of many financial institutions. That's exactly what we've been talking about all along.
Yeah, and that's why we're to be multi-goddamn reason.
Yes, sir. There's 1,258 insured U.S. financial holding companies in the market. And out of all of those, 4 of them dominate in derivatives exposure. 173 trillion in liabilities, notional amounts of derivative contracts, compared to only $8 trillion in assets. Ladies and gentlemen, we're going to be filthy fucking rich. Get the fucking money printer out, Jerome. You're going to need it, you fuck. on that one, I bid you good day, my friends. Again, I can go on, but I think that's enough. I don't think old Kenny Boy could take any more. We're gonna be so fucking rich. Hope I didn't scare anybody. Goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff.
Peace out, everybody. It's great to see you. Hilsey, Dana, Joey, Pam Trader, Diaz, Pantheon, everybody in the think tank, everybody out there. Really appreciate all you guys, retail investors. If you see me out and about, say hi, everybody. Don't worry, I'm not shy. Don't be shy either. Hey, Adam, Dwayne, it's good to see you guys. Have a great day, everybody.
Motherfucker. Holy shit, we're gonna be so fucking rich. Damn it, we're gonna be so fucking rich. Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
yelling, give me the fucking money. Get the goddamn money printer out.
Great. The bounty cutter.